Goldman Sachs has warned that home prices in these 4 American cities may see a severe decline, similar to the one we saw in 2008 housing crash. Yikes. According to a recent note to clients, Goldman Sachs stated that San Jose, Austin, Phoenix, and San Diego may experience drops of over 25% from peak to trough. This forecast is based on the expectation that interest rates will remain high and that 10-year Treasury yields will peak in Q3 of 2023. As a result, the bank has raised its forecast for the 30-year fixed mortgage rate to 6.5% for the end of 2023. Just for reference, here in San Diego, I'm seeing jumbo loan rates around 5.5% and conforming rates right around that 6% mark, which is the lowest it's been in 4 months. So they're basically forecasting rates to continue to rise over the coming months and throughout the year. The report also goes on to say such declines would rival those seen around 15 years ago during the Great Recession. Home prices across the United States during the Great Recession fell around 27%, according to the S&P CoreLogic Case-Shiller Index. In 2023, Goldman is forecasting double-digit home price declines in key markets like Austin, San Francisco, San Diego, Phoenix, Denver, Seattle, Tampa, and Las Vegas. Keep in mind, these were one of the cities that probably appreciated the most during the pandemic. Austin has already dropped 10.4% from its 2022 peak house price, meaning its boom-to-bust decline could be north of 25% if the trend continues into this year. According to Forbes.com, it's highly likely the Fed will raise interest rates by a 0.25 percentage point when it announces a decision on February 1st, 2023. Additionally, the market predicts that the Fed will likely make a similar move during its meeting on March 22nd, though there is a small chance that they may hold rates steady. The main significance of these meetings will be the Fed's plans for interest rates in coming months of May and June and beyond. However, it is worth noting that while many Fed policymakers have suggested that rates will increase above 5%, the market currently expects rates to remain stable or even decrease later in 2023, although it seems like Goldman Sachs does not agree with this statement. I guess we will have to wait and see. As I've mentioned in previous videos, a number of San Diego's neighborhoods that appreciated the most during the pandemic, like Carlsbad, Del Sur, Solana Beach, Rancho Penasquitas, have already seen price corrections of 10% plus. But to say prices will dip another 15% feels like a little bit of a stretch to me, unless mortgage rates go up into the 8% range. I guess anything is possible in this market. Inventory has increased slightly in the new year from what I've seen, but there is nowhere near the amount of homes we would need to see prices dip more dramatically, but things can change quickly in the real estate market. Maybe the spring selling season brings all the home sellers out of hibernation and floods the market with housing, or home builders double down on building. But as I've said in my previous video, in 2007 we had over 27,000 homes on the market during the Great Recession. As of December 22nd, we have 3,221. We'd have to 8 times our current inventory to come close to those levels again. I believe less homes will be sold this year due to lack of inventory and higher interest rates than we normally see, which will prevent home prices from dropping too much more for 2023. We currently sit at just over 2 months supply of inventory. For a so-called balanced market, we would need to be somewhere between that 4 to 6 months supply of inventory. Keep in mind, I am not an economist. I'm just a realtor in San Diego that likes to make videos about San Diego. In fact, if you haven't already, you should subscribe to our channel to learn everything you need to know about what it's like to live in San Diego. With that said, I'm sure Goldman Sachs has people slightly smarter than me looking at the data that has led them to this conclusion. But a lot of their conclusions are based on mortgage rates rising higher for a much longer period of time, and that remains to be seen. I also searched around some other websites and financial institutions to see what they think is in store for the 2023 housing market. A recent report by New Western, a platform for fix and flip residential properties, revealed that despite the current challenges in the housing market, such as low inventory and high interest rates, investors remain optimistic heading into 2023. The report found that 73% of investors saw growth in their business from 2021 to 2022, which really isn't that surprising, and 70% plan to invest this year. Additionally, 63% of first-time investors surveyed stated that the interest rates were not high enough to discourage them from buying, with 59% planning to use cash or private funding for their purchases. The report also noted that the departure of iBuyers like Redfin and Zillow and other tech companies could create more opportunities for smaller investors, and that high interest rates may make a fix and rent strategy more favorable than a fix and flip strategy. So we'll see what happens with that. According to Redfin, San Diego and Phoenix are among the most popular markets for seller concessions. These concessions include offering buyers money for like home repairs or mortgage rate buy downs, as homeowners continue to sell homes for below the asking price. Although that is not happening everywhere, as I've seen multiple offers in a few situations early on in the new year here. So with all that being said, Goldman forecasts U.S. home prices to fall by 6.1% this year. This represents a full decline of about 10% from peak to trough nationally in the U.S. housing market from June 22nd until the end of 2023. This decline should be small enough as to avoid broad mortgage credit stress with a sharp increase in foreclosures nationwide seeming unlikely, the report says. This means that the boom to bust crash is not expected to be even half as bad as the 2008 meltdown, with the possible exceptions of the 4 cities mentioned above. The investment bank also offers a glimmer of hope as it foresees that the housing market will not experience a long-term downturn as it did in 2008. Goldman is projecting an overall rise in house prices of around a whopping 1% in 2024. Woo! So what do you guys think? Is the San Diego housing market doomed in 2023? The new year has brought more buyers to the market with lower interest rates on the horizon. Will that continue? You'll have to subscribe to my channel to find out. Thanks for watching.